Please don't close this video. I'm recording this right now, 6 hours before the markets open, because what is on this screen can't wait for a scheduled upload, a polished edit, or a carefully timed release after the opening bell has already moved prices too far for this analysis to be useful. For 6 hours. That is the time between now and when every institutional desk, every algorithmic strategy, and every sovereign fund manager in every time zone all hit the market with positions they have been building overnight. There are 6 hours between the data I'm about to show you and the time when that data is priced in real time in front of millions of people who won't have the same information you do. You should watch this all the way through, not halfway, not at 2x speed, everything. Because what I see right now, silver at $86, gold at 5,300, oil at 118, and a war that grew overnight into a theater that no one in the mainstream financial media was pricing 72 hours ago, is not 4 separate overnight headlines. It is a historic event that happened overnight, and the last chance to understand it before the market prices it for you is the 6 hours before the market opens. While most people were sleeping, this is what happened. Gold went over $5,300. Take a moment to think about that number. Not $3,000, not $4,000, $5,300 for every ounce. A level that mainstream analysts thought would take years to reach, even with the most positive assumptions, just 12 months ago. In the overnight session, silver is selling for $86. Oil prices have shot up to $118 after it was confirmed that the war would spread to an area that is directly above important energy infrastructure. And the conflict that caused that oil move has crossed a geographic line overnight that many geopolitical analysts had said would turn a regional conflict into a global supply chain emergency. Last night, that line was crossed. You have 6 hours. Stay with me through every second of this. I need to tell you something about pre-market moments like this one before I go over what happened and what it means. I know what they do to retail decisions because I've watched enough of them. Almost always, they do the wrong thing. When the pre-market session shows numbers like these, gold at $5,300, oil at $118, and silver at $86, retail investors feel 2 different ways at the same time, and neither way leads to a good decision. The first thing to do is panic. At these price levels, portfolio positions look different. Risk feels different. The need to act right away, buy, sell, or do something before the opening bell, completely takes over the analytical process. People make decisions based on the number on the screen instead of understanding what caused that number and what it means for the future. The second way is euphoria. For investors who have been in precious metals and energy, seeing these numbers before the market opens gives them a sense of vindication that is just as dangerous. The desire for vindication is the enemy of ongoing careful analysis. The second you think you know the answer is the second you stop asking the questions that will help you figure out what to do next. Both of those feelings, panic and happiness, lead to the same result. They make you act based on what you see on the surface instead of what is going on beneath the surface. And in a pre-market session where 6 hours of clear analysis separate you from the noise of the opening bell, doing something on the surface is the worst thing you can do. In this video, I'm going to show you the depth, how each number works, the link between them, and the framework for getting around the open with the clearest possible picture of what is really going on in this market, not just what it looks like from the headlines. 4 layers. Everyone is important. Layer 1, gold at 5,300. What this level really means structurally. When the markets open in 6 hours, retail coverage will say that gold crossing $5,300 is a round number milestone. But it's not. It's not just the next level of psychology on a chart that has been going up. Before the story catches up to it, the price shows that there was a specific and historically important structural event in the global monetary system. This is what $5,300 gold is really measuring. It is measuring how quickly sophisticated capital is changing the value of the dollar-based international monetary system in response to the overnight war expansion that I'm about to describe in detail. And that change in price is not happening slowly or in small steps. It is happening in a pre-market session. And in one overnight move, it covers more ground than gold usually does in a month of normal trading. When gold moves this quickly before the market opens, it's not because retail investors are reacting to a news story. People who invest in stores are asleep. What caused gold to move $200 in one night was capital at the sovereign and near sovereign levels using pre-planned strategies that were made just for the situation that happened last night. These are not positions that react. These are positions that have been set up. Positions made by people who knew weeks or months ahead of time that the geographic threshold would be crossed overnight and who built their gold exposure before the trigger happened instead of in response to it. The $5,300 level is where those pre-positioned strategies are currently being partially liquidated into strength. This is not because the buyers have changed their minds about gold, but because disciplined position management at this level requires taking partial profits at set levels to keep the ability to add back on any consolidation. That partial liquidation will cause the first drop from the $5,300 level when the markets open. It will look like something that is stopping it. It will make headlines like gold faces selling pressure at $5,300. In the most basic sense, it is not resistance. It is institutional profit management within a broader position that has maintained its directional perspective. Knowing the difference between institutional profit management and fundamental resistance is what lets you see the first pullback from $5,300 as a reversal signal or as a chance to get back in on a move that is still going strong. Layer 2. Oil at 118, the overnight change. That changed everything. Let me tell you exactly what happened overnight that caused oil prices to go from their previous level to 118. The specific nature of the war expansion that caused this move has effects that go far beyond the energy market and into the silver and gold markets as well. The geopolitical risk premium for commodities markets has been high for the past few weeks because of a conflict that crossed an important geographic line overnight. I can't say exactly which theater crossed that line in a way that would make me have to update this analysis every hour as the situation changes. However, I can talk about the structural importance of what crossed that line in a way that will still be useful for analysis, no matter what the operational details are. The area where the conflict spread overnight is where three important global energy infrastructure systems meet. The first is a big crude oil pipeline corridor that moves a significant amount of the world's daily oil supply from production areas to export terminals. The second is a facility for processing and exporting liquefied natural gas. Many European economies have become structurally dependent on it since the supply disruptions of the past 2 years. The third is a maritime choke point, which is a geographic bottleneck that sees an unreasonably large amount of the world's seaborne energy trade pass through it every day. When a conflict spreads to an area that threatens all three of those infrastructure systems at the same time, the oil market doesn't gradually raise the price of the chance of disruption. It sets the price for the worst-case scenario of all disruptions happening at once right away, and then lowers it as the situation becomes clearer. The market price of oil at 118 poses a risk of disrupting all three systems overnight. The way to get from 118 to the next level depends entirely on which of those three systems is actually having problems with its operations and which is only at risk of being close to them. But this is the most important thing that silver and gold investors need to know that the energy market conversation isn't getting. Oil at $180 because of geopolitical infrastructure risk is not the same as oil at $118 because of demand growth. When oil prices go up because of demand, it causes inflation and usually leads to a policy response from the Federal Reserve that makes it harder for precious metals to rise in value by raising interest rates. Geopolitical supply shock oil price increases are stagflationary because they combine inflationary pressure with economic disruption in a way that has historically led to the best performance of gold, silver, and energy assets at the same time. What happened overnight isn't an oil story for people who invest in precious metals. It's a story about stagflationary catalysts. And stagflation is the big picture in which silver's combined demand for money and industry makes it perform best at the same time. Layer 3. Silver. At 86, the overnight lag and what it means. Let me now show you the most important analytical signal that is hiding in plain sight during this overnight session. The price of gold is $5,300, the price of oil is $118, and the price of silver is $86. Silver is behind. In an overnight session, gold and oil both moved a lot, but silver only moved a little bit. It didn't move as much as either of the other two assets it trades most closely with. And that lag isn't a bad sign for silver. It is one of the most reliable signs that the precious metals market is going up. This is why. Gold moves first in overnight pre-market sessions because it is the deepest and most liquid precious metals market in the world. Sovereign level capital can move a lot of gold without having the same effect on the market as it would in the shallower silver market. Oil goes first because people in the energy market trade all day and night, and it has the most advanced infrastructure of any commodity market. Silver always moves later because its market is less deep, its overnight liquidity is lower, and the people who make the biggest silver moves are mostly active during regular trading hours, not overnight sessions. The difference in time between gold's and silver's overnight moves does not mean that silver is being left behind. It is silver that is being loaded. The same things that caused the overnight gold move, sovereign buying, stagflationary macro catalysts, and geopolitical risk premium expansion, also caused the silver move when the regular session starts. The silver market is fully liquid. People who know how the lag dynamic works aren't worried about silver at $86 in the 6 hours before the market opens. they are keeping an eye on it because they know that when the market fully opens, it will bring in silver-specific buyers like industrial hedgers who are reevaluating their procurement costs in a $118 oil environment, monetary investors who trade silver instead of gold because it is more volatile and gives them more leverage to the same macro thesis, and algorithmic strategies that trigger silver buying when certain gold to silver ratio thresholds are crossed. These buyers will be coming into a market that has not yet fully priced the overnight developments. When gold is at $5,300 and oil is at $118, silver at $86 is not a laggard. It is a spring that is coiled up, and the market opening in 6 hours is the way to get out. Layer 4, war expanding, the line that was crossed and why it can't be crossed again. Now let me get right to the point about the geopolitical level. This is the level that affects how long each price level lasts, and it's also the level that most financial analysts will downplay when markets open, because they are taught to think that geopolitical events are short-lived and will eventually return to normal. This one isn't. The geographic threshold that was crossed overnight is different from the many geopolitical escalation events that markets have seen and forgotten over the past 10 years. Irreversibility is that quality. Most geopolitical tensions can be undone. It is possible to pull back a military incursion. You can get rid of a sanctions regime. You can talk someone out of a trade restriction. The market takes into account both the chance of a reversal and the chance of a continuation. And the price change is limited by how long the escalation is expected to last. The threshold that was crossed overnight cannot be undone on any timeline that is important for market pricing. The geography, population, and infrastructure of the area where the conflict has spread make it impossible to go back to the way things were before the expansion in 1, 2, or even 5 years. The people who set the overnight gold price at $5,300 and the overnight oil price at $118 are not pricing in a geopolitical spike that will go away when things calm down. They are pricing in a change in the way risks are handled that won't settle down on any timeline they are willing to accept at current rates. That is what it means to be in a war with no way out. A war with no exit is not priced the same way as a war, as I said in a previous video on this channel. It is priced as a permanent change in the risk landscape, which means that the premium that capital needs to hold assets that are exposed to that landscape must be changed permanently. The price of gold at $5,300 shows that change starting to happen. That adjustment isn't fully shown yet at $86 for silver. The energy market is showing the same change in oil prices at $118. The last time, you can see the gap between where these assets are and where the full expression of the overnight development will eventually take them is in the 6 hours before the markets open. After that, the gap will be gone and the prices will have already been set. All of the data points and analytical frameworks in this video are based on public information that can be checked. You can see the overnight prices I mentioned, gold at $5,300, silver at $86, and oil at $118 on any real-time commodity data platform during the pre-market session. The screenshots have a date and timestamp and are saved. I put them in the description and pinned them to the comments. The academic market, microstructure literature on precious metals, price discovery talks about the gold-silver ratio lag dynamic I talked about, where silver always moves after gold in overnight sessions and catches up during regular trading hours. The pattern can be statistically replicated using several years of intraday data that compares gold and silver's overnight and regular session moves. The difference between oil price increases caused by demand and those caused by supply shocks, as well as their different effects on precious metals, is well documented in the peer-reviewed commodity economics literature and in the published research of the major commodity banks going back to every major oil price shock since 1973. The distinction between irreversible and reversible geopolitical escalation and its varying effects on risk asset pricing is elucidated in the academic literature of international relations and finance. The analytical framework I utilized for the overnight development is not proprietary to me. It comes from research that has been published and that I have linked to in the description. Look at every reference. Check each framework. The analysis is either solid or it isn't.